we're going to finish off with the finalised tax ruling in relation to vacant land. That is the provision that denies a deduction for holding costs on vacant land. Now, I've drawn up a flow chart here. So we're talking about one section, section 26-102. And so here's the flow chart to try and help you work that out. So we start off and we ask ourselves, do one of the exclusions apply? Now, I'll get to that in the next slide. If one of those do, as you'd expect, then the section doesn't operate. If it doesn't apply, then we ask ourselves whether we actually have got an outgoing that's been incurred in relation to holding land. For example, interest, land tax, and so on. And of course, if we haven't, well, then we don't have anything to worry about in the section. Now, the next important question for you to focus on, and this is one of the key things, is there a substantial and permanent structure in use or available for use on the land? And we'll talk more about what that means, but that's our first question. If there is, then we also have to ask ourselves whether that structure is independent of and not incidental to the purpose of any other structure or proposed structure on the land. And if it is, then we have no operation of the provision. So we've got our substantial structure and it's independent of another structure. Therefore, we don't have, in essence, vacant land, according to the way this provision works. Yeah. Going up is, if there is not a substantial and permanent structure, that's not the end of the process, we then have to ask ourselves whether, if I'll call it the business exception, applies. So is the structure being used or available for use in a business by the required persons? And I've got a slide coming on that as well. Who are these required persons? So there's this kind of business exception, if you like. And if that's the case, then what will happen is that 26-102 will restrict the tax deductions to outgoings to the extent that the land is available for carrying on the business. So there is this business exclusion. And if the answer is no, then we get the outgoings denied. Now, just to complete the picture there, let's say we did have a substantial structure, but it wasn't independent of and not incidental to the purpose of any other structure, then we would come back and ask ourselves the business question, and again, the same result. So I'm just going to go to the next slide. Do one of the exclusions apply? So just coming back up to here, there's a number of exclusions. The first one is the type of entity. So if you've got a company, that's excluded, a super fund's excluded, and those other ones there. Oh, note that it's not an SMSF. Sorry, it's a super fund, but not an SMSF. If the structure's been affected by natural disaster, so the idea here is if you've got the structure, a fire comes through and burns the thing down, and so now you've got vacant land, it wouldn't be fair if you were denied your deductions because the fire came through. So that's an exception. There's another one for land being leased by a primary producer or their associates, and there can't be residential premises on the land. And there's another one where we've got an arm's length lease and the land being used or is available to use to conduct a business, but again, no residential premises on the land. Now, just coming back to that business exception, these are the people that have got to be carrying on the business. So you are the taxpayer incurring the expenses. So if the business is being carried on by you or your affiliate, or if you're an individual, your spouse or any child who's under 18 years of age, or an entity that's connected with you, and of course that picks up the small business ideas. If you're any one of those, then you can get some deductions at least for the holding costs. Now, the big deal is, what's a substantial and permanent structure? And this is something that the tax office is kind of defining for us in this ruling. A substantial structure is significant in size, value, or some other criteria of importance in the context of the property. Okay, so we look at our property, however big or small it is, and we look at this structure and we say, is it significant in the context of this property? And if it is, then we get the tick. But to be permanent, a structure needs to be fixed and enduring. Now, another thing to understand is that there is a further exclusion, which is in of note that needs to be looked at in subsection 4. So we treat a building as not being a substantial and permanent structure, even though it is in first instance, if it is residential premises constructed or substantially renovated while you hold the land. So first of all, residential premises are excluded unless the residential premises are lawfully able to be occupied and the residential premises are leased, hired or licensed or available for lease, hire or license. So we can have a claim for the deduction if we have our residential premises here and it's either available for rent or being rented. But if, for example, we were constructing our building, even if it's substantially constructed, if it's not able to be occupied and it's not available for rent, then we can't treat that as a substantial permanent structure, and chances are good we'll lose some deductions.
Yep, that's fair.
So let's have an example. Now, this just highlights the tax officer's view about what it means to be substantial in the context of the property. Okay, so here we have this house, which probably doesn't cover a lot of area, and we've got 100 acres of land, and we've got all the sheep and cattle. Now, the property is vacant, but it's capable of being occupied. Now, what the tax office says is that the house is a substantial and permanent structure with an independent purpose. It is not incidental to any other structure, okay? This is so even though the house is small compared to the total amount of the land, because we might have thought, the house might only be, 2 or 3 bedroom house, and in the context of 100 acres, that looks pretty small, doesn't it? So therefore it's not substantial. But however, the tax officer said, no, it is substantial. Why? Well, they don't actually explain it, but they just say it is. And so I suppose the idea must be that in the context of the property, it's the place where the people live that operate the property maybe, and therefore that makes it substantial. So another one here we have Leon, who is going to build a house on a vacant suburban block. Now, there's a shed on the block, and there's also fences around 3 of the sides, both sides and at the back. So have we got a substantial and permanent structure? And so, yes, she wants to build a house there. The tax office says the fence and the shed are not substantial and permanent structures with a purpose that is independent of any other proposed structure on the residential block. Now, I suspect that there are going to be all sorts of things that fall between the example I'm showing you here and the example in the last one, and no doubt fact situations will become across by accountants in public practice where they'll scratch their heads and say, is that substantial or is it independent from the other one? And one assumes we'll get some cases on this. Now, one other thing that is not spelled out in the ruling, but I just want to make this point, is that it seems that when we talk about pieces of land in the context of 26, the provision, is we're talking about each title. So let's say we had 5 titles that are co-joined in one sort of big property. It seems that you need to look at each one. Now, I'm concluding that myself. This is not said in the ruling, but that seems to be the way that it is treated. So you look at each title and you say substantial or permanent structure, and then go to another one, substantial or permanent structure, and so on.
Yeah. So, for example, if we went back to that 100-acre square, if that was actually 2 titles and then obviously the house only sat on one, then what you're saying is maybe all the deductions might be denied for that totally vacant one, unless
may-
an exemption applied
Yeah, that's
for
right.
it. Yeah.
You might get the business thing or the primary production
Yes, yeah.
thing there, but yes, yeah, the thinking is right. Yes.
Mhm. Yeah.
And the thing about this is, don't forget the third element of the cost base. So if you do get some denied deductions, don't give up, because it may be that you will be able to get them, and very likely will be able to get them into the third element of the cost base. So at least you get a tax deduction when you go to sell the property.
Yep.
The key thing is make sure you keep the records of it.